Welcome to BDO Talks ERISA, a monthly podcast recorded live at BDO. Each month, we'll be talking best practices around all things ERISA, how to avoid common compliance issues, how to navigate the tricky ins and outs of ERISA's fiduciary provisions, and discussing our own experiences working for BDO's ERISA Services Group and the insights we share through the ERISA Center of Excellence. Be sure to rate, review, and subscribe on iTunes or Spotify. Let's get started.
Hi, my name is Nay Redmond, and I'm an audit manager for employee benefit plan audits here at BDO. I've been auditing employee benefit plans, including retirement plans, for almost 10 years now, and I've been at BDO for a little over 2 years. And with us today, I also have Daniel accompanying us.
Hi, my name is Daniel Kugel, and I am an employee benefit plan audit manager like Nay. I've been with BDO for a little over 5 years, and I've been auditing employee benefit plans for more than 10 years. Today, we have our guest, Nicole Parnell.
Hi, good afternoon. Thank you so much for having me. My name is Nicole Parnell. I'm a managing director here at BDO, and I lead retirement plan services within our specialized tax services, global employer services practice. I've been here at BDO since 2016, but have been involved in the administration of qualified plans for, I'll say, 20 plus years. So a long time. Thank you for having me.
Thank you, Nicole.
I'm glad that you're with us here today, Nicole, with such extensive experience because, as you know, the Secure Act has brought a lot of changes that will be rolling out over several years at this point that employers have to pay attention to. So with that being said, what are some of these key changes that are being implemented, especially in the near future?
Great question. The Secure Act has a lot included in it. But I can say right now, one of the biggest topics around this is, what's happening with long-term part-time employees. So prior to the Secure Act, employers could exclude employees, from their defined contribution plan based on the number of hours that they work per year. So as you can imagine, this impacted part-time employees who were typically ineligible to contribute to the plan, regardless of maybe how many years, they'd been working for that employer. The 2019 Secure Act included provisions that allowed employees who have worked at least 500 hours within 3 consecutive years, and this starts with employment back in January of 21, to begin contributing elective deferrals effective with the first plan year beginning in 2024. So here we are in 24. And so this new category of employees is called long-term part-time employees, or LTPTs, which is a little bit of a tongue twister there, but we'll refer to them as LTPTs as we talk. Then in 2022, the Secure 2.0 came along, which has been updated to state that beginning in 2025 and later years, that 3-year period that we're looking at would be reduced now to 2 years. So employees who worked at least 500 hours within 2 consecutive years will now be eligible to make deferrals into the plan. One thing that's important to note is that plan sponsors are not required to make any employer contribution for these LTPT employees. They only have to allow for them to make salary deferrals. They certainly could make employer contributions if they want to, but it's not a requirement. The other piece of this is that the LTPT employees will also receive vesting credit for each year in which they're working at least 500 hours, but less than 1,000 hours. So while vesting percentages may not have any impact if the plan sponsor is not giving employer contributions, that vesting still continues to carry over in case any of those LTPT employees do become eligible for employer contributions in the future. So that's a really nice provision that was also included.
Thank you, Nicole. How will these changes affect plan sponsors in the short term?
Well, there's a lot of things that the plan sponsors will want to consider, relating to these provisions. The biggest thing is the current plan design and the plan documents. As we all know, working with these plans, the plan document really is the go-to. It determines everything. So with these provisions, the plan sponsors definitely want to be talking with their service providers, looking at the current plan design, looking at those plan documents to identify if there's any issues that might need to be addressed. A good example of this might be, should they consider lowering eligibility requirements for the plan overall, so that any employees, including those that are working at least that 500 hours, are eligible to make salary deferrals. Doing that would make the administration much more simple. It would reduce the risk of tracking those eligible participants, enrolling them, because you don't have to have those separate categories of, these employees meet this, but these employees meet that LTPT provision. The other thing could be looking at how are we determining eligibility, whether it's a period of service through elapsed time, or are we still looking at hours of service? And sometimes we find that elapsed time could be much easier to administer and much easier for participants to understand as well. One thing to keep in mind is that the plan sponsor can still exclude certain classes from the plan as long as that is clearly defined, such as a certain job classification or job title. Also, remembering, though, that pesky 410B coverage testing still has to pass, anytime you have those certain exclusions that are stated in the plan document. So coverage testing, super important. And then finally, making sure that there is a service provider that you're working with that knows the plan, knows the demographics of your employees, understands how your business is changing, how you're hiring, and how all of that impacts the plan design, as well as, what are the best provisions to ensure operational efficiency and compliance. So there's so many things to think about with all of this, but I think a key point is having a service provider that understands all of the factors and then also can help the plan sponsor be compliant.
It sounds like there's a lot of compliance matters and requirements that plan sponsors need to be looking at right now to be prepared for these changes. So with regard to the formal amendments to the plan provisions related to the LTPT eligibility requirements, is there a deadline or a timing requirement that plan sponsors have to have executed these documents? And would this determination be based on Form 5500 reporting year or plan year in the case that you have plans that report on a non-calendar plan year?
Yes, the IRS recently issued notice actually to extend the deadline for both the required and the discretionary amendments that are related to the Secure Act. And so they've pushed that to on or before the last day of the plan year, beginning on or after January 1st, 2026. So we've got a little bit more time to look at this. I know that service providers also that have plan documents and amendments, may not all be ready to implement those amendments quite yet because we're waiting on additional guidance on certain features. But we have plenty of time. This same timing applies to all non-governmental 401A, 401k, and 403B plans. So like I mentioned, service providers are working to have those amendments available. But either way, you want to be having those conversations now to ensure that you can comply, right? As a plan sponsor, you want to be able to comply. You want to be talking to those service providers. How are they going to help you comply? An important reminder, too, is that those plan sponsors must operate in accordance with the law changes based on those statutory effective dates, even if the amendment has not been yet executed. So important to keep track of all the discretionary provisions as a plan sponsor that you'll be choosing so that everything can be incorporated in the future. So absolutely. And this is, again, based on the statutory dates that have been provided with that beginning on a plan year after January 1 or 2026. So that should help with those non-calendar plans that are fun to look at date-wise. A couple other things I did want to mention, because I know we were talking about kind of what's important, here in the short term. Participant communication obviously is super important. How are you ensuring as a plan sponsor that impacted employees are receiving any required notices, any documents such as the plan's summary plan description, any enrollment materials? And, I think this is a great opportunity to also expand any retirement education, to the employees. So gather everybody together in a conference room, have lunch, talk about it, help them understand. Again, working with the service providers, they've got to update their systems to make sure that they can track anything related to the long-term part-time employees. You want to avoid any type of compliance issues with that, whether it's the record keeper, your payroll provider, or a third-party administrator that may be helping. And the fact that we've got to go back and look at some prior years, right? So we're going back to 21 through 2023, so that now in 24, you're compliant. So definitely important to have those systems in place and working together. Fees, cost, what is this going to do to maybe the cost of the administration? So definitely want to make sure that any changes in processes to handle this, as well as any impact on fees, are discussed, looked at, so that everyone understands who's doing what, who's responsible for which piece, and how much is that going to cost. And then you mentioned a little bit ago about Form 5500. So, long-term part-time employees, how is this going to impact that headcount that's recorded on 5500 and possibly push a plan into audit status? Beginning, with the 2023 plan year, 401k plans that have more than 100 participant account balances as of the first day of the plan year are now required to have an audit. So as a reminder, before 2023, plan participants who were eligible to make salary deferrals were counted as participants, even if they were not contributing anything to the plan. So this change can really help smaller size plans go under the threshold and remove that audit requirement. But at the same time, implementing long-term part-time employees and those provisions could turn around and increase the number of account balances and throw them right back into that audit status. So monitoring the count is super important for planning purposes, not only for compliance, but also, again, back to budget costs for a plan audit or just fees in general. And then the last thing I would mention is if it's not been implemented properly, corrections could be very costly. So we want to keep that in mind as well.
So considering the LTPT component of the Secure Act became effective in 2024, if you missed implementation, how do you catch up? Let's say an employer did not track LTPT hours timely, and they discovered that they had not informed LTPT employees of their eligibility accordingly in 2024. What action should plan management take next to ensure plan compliance and redeem their due diligence?
Great question. So as you can imagine, increasing the number of eligible employees now increases the possibility of someone being missed or miscategorized. The employer must take steps to correct any instance of where an employee that is eligible was not notified and not provided that opportunity to participate in the plan. Any delay in that communication to those employees that causes a delay of payroll deductions of those elective deferrals beyond their eligibility date would be an operational failure that would need to be corrected under the IRS's correction program, which we like to call EPCRS, Employee Plans Compliance Resolution System. So while corrective contributions to make up the employee's miscontribution or misdeferrals are not always required, notices would need to be provided to any of those participants that had a misdeferral period to advise them that their future retirement savings might need an adjustment due to that delay. So they can adjust that going forward also, even if a corrective contribution is not provided. If plan sponsors have not made the necessary process changes to track this properly or enhance their reporting with their service providers, they should immediately review that now and then ensure it's compliant going forward. as well as making sure that they're reviewing that prior employee data to capture any missed employees and correct that according to the IRS requirements. I know that there are many service providers out there now that are offering 180 or 360 integrations with payroll to help capture eligibility and to ensure that those deferrals are timely set up as payroll deductions. And this includes any plan that may have automatic enrollment provisions as well. The more information is tracked electronically and does not require any type of manual tracking, the less chances there are for errors and then those costly corrections.
Thanks for that explanation, Nicole. You've mentioned the procedures and the impact that plan sponsors need to take on what seems like their daily operations in the short term. So in addition to the short-term impact, how would these changes affect the plan sponsors in the long term?
Well, I know I mentioned before the participant count changes as it relates to Form 5500 and that audit requirement. So it's not just a short-term priority. It really is a long-term impact, as if the plan is now required to have an annual audit and continues to grow in the number of account balances. That audit cost becomes a recurring budget line item, but also could increase as the amount of time and resources required for the audit, to be completed, continue to grow. So as you get bigger and bigger and bigger, more time is needed and costs continue to increase. So kind of projecting ahead, I think, budget-wise is really important for a plan sponsor. Similarly, the plan will likely incur an increase in the plan administration costs. So the service provider, third-party administrators may be updating systems to account for this new category, as well as additional team hours that are required to complete any compliance reporting, testing, and plan valuation packages. The plan sponsor really should be looking at their service agreements and fee schedules with the various providers to ensure there's full transparency of any changes, as again, this impacts overall costs associated with maintaining the plan. Now, of course, increased retirement savings for employees, which is a positive impact, for the employees, having this ability to defer when they didn't have that before, helps retain employees. So all of these benefits surrounding retirement is a great recruiting and retention tool, especially in a case where a plan sponsor also decides to provide that employer contribution to the LTPT employees, even though it's not required.
And Nicole, maybe you can leave us with some best practices, best steps for plan sponsors to consider in light of these changes.
Sure, absolutely. So one of the other provisions that came from the Secure Act actually increased the account balance threshold for mandatory distribution. So when you have terminated individuals that still have a balance in the plan, previously that threshold was $5,000, and that is now increased to $7,000. So by implementing this provision, you can help keep the plan cleaned up for small balances, and the count, that participant count that impacts the 5,500 an annual audit requirement, keep that as clean as possible. Many of the record keepers that are out there are automatically implementing that $7,000 threshold increase as part of their defaults, unless they hear back from the plan sponsor. So I would say, plan sponsors, if you haven't talked about that yet, definitely do that and work with the provider to make sure that that's updated and then track it for your plan amendment later. Look at all of your procedures, reviewing all procedures to ensure compliance. This includes tracking of hours worked, eligibility determination, entry dates that are based on the plan document, as well as the LTPT regulations. Clear and timely communication to all employees on these plan provisions and the enrollment process. All of this analysis is very important, both internally and externally with your service providers, keeping everything compliant. Reviewing employee demographics each year, as well as when making decisions about business expansions to understand the full impact on the plan, and doing that ahead of time versus after the fact, and then that's when those corrections happen. So always be proactive with anything regarding the plan. With regards to service providers, again, periodic benchmarking of those providers. What are they doing to help keep things compliant and efficient? What are the costs as your plan grows? Does that give you a little bit more bargaining power with your fees? And are they doing things technology-wise that would provide enhancements for you to be able to remain compliant? I think that's really important. And then just the plan sponsor themselves, staying on top of regulatory changes. I like to say it's job security. The law changes a lot. I mean, the Secure Act has been very significant for all of us that focus on retirement plans. But I would say plan sponsors really need to stay on top of that as well, paying attention to what's going on and how that may impact their plans.
Thanks, Nicole. I believe you made the Secure Act provisions with respect to the LTPT employees a lot easier to understand and a lot easier to determine how plan sponsors can move forward in preparing themselves, since the Secure Act is, like you said, it's broad, there's a lot of changes, and it's affected all of our work. But with that being said, if you are a plan sponsor or a professional that has questions about the LTPT provisions that we discussed today, please feel free to reach out to us, and especially Nicole, she's awesome. And you can refer to the show notes as well for our contact information. And of course, it was good seeing you again, Dan and Nicole. Always good to see you guys.
Thank you for listening to BDO Talks ERISA. Past episodes and information about how to join us for our next live recordings are available at bdo.com/BDO Talks ERISA. Or you can go to iTunes or Spotify to rate, review, and subscribe. The views expressed by our guests do not necessarily reflect the views of BDO. For more information on BDO's ERISA Center of Excellence and the services we provide, visit bdo.com/ERISA.